Something big is building under the surface, and most people still don't see it. We are not just talking about a normal recession or a temporary slowdown. The signals coming from global markets, rising debt, and geopolitical tension are pointing towards something much deeper, a potential economic and political breakdown. And if this trend continues, it may not happen in smaller economies first. It could begin at the center of the global financial system itself. Welcome to Gold Silver Scope, where we break down complex financial events into simple ideas so you can understand what's really happening with gold, silver, and the global economy. Let's start with the core issue. The system is under pressure from multiple directions at the same time. Back in 2022 and 2023, we already saw a major inflation spike. That forced central banks to raise interest rates aggressively. When interest rates rise, borrowing becomes expensive, and governments, especially heavily indebted ones, begin to feel the stress. Now here's the real problem. Today, the global debt situation is far worse than it was just a few years ago, especially in the United States, where debt levels have reached historic highs. This creates what analysts call a debt trap. In simple terms, governments are stuck. If they raise rates, they damage their own economy and increase debt servicing costs. If they lower rates, inflation comes back stronger. There is no easy way out. At the same time, geopolitical tensions are rising again, particularly in the Middle East. Many people think of war only in military terms, but the real impact is often economic. Energy prices can spike suddenly, supply chains get disrupted, and inflation rises even faster. This is exactly what we saw before. And now it looks like it could happen again, possibly on a bigger scale. Energy is the backbone of every economy. When energy becomes expensive, everything becomes expensive, from food to transportation to manufacturing. And when inflation rises faster than wages, people lose purchasing power. This creates pressure not just economically, but politically as well. Now here's where things get even more interesting. Financial markets are not reacting as strongly as they should, at least not yet. Stock markets are still relatively stable. Bond yields are rising, but not dramatically. It's almost like the system is frozen, waiting for something bigger to happen. This kind of calm can be dangerous, because historically, before major financial shifts, markets often appear stable right before volatility explodes. Investors, by instinct, move toward what they believe is safe, and traditionally, that has been the US dollar. But here's the key insight. The dollar itself is not real money in the traditional sense. It is credit. Its value depends on trust in the system behind it, and that trust is starting to weaken. At the same time, we are seeing signs that major global players are quietly adjusting their strategies. There are reports of increasing demand for physical gold, even shortages in some areas. This suggests that smart money may already be moving out of paper assets and into real, tangible assets. So what does all of this mean? It means we may be entering a phase where the old financial system starts to crack under pressure. Rising debt, rising inflation, geopolitical conflict, and weakening trust in fiat currencies. All of these are coming together at the same time. And when that happens, gold and silver are no longer just investment options. They become financial protection. Now let's go deeper. Because what's happening behind the scenes is even more important than what we see on the surface. Right now, there is a silent shift happening in the global financial system. It's not loud, it's not dramatic, and most people don't notice it. But it could change everything. One of the biggest questions investors are asking is this: is the US dollar still the ultimate safe haven? In times of uncertainty, money usually flows into the dollar. We are seeing that again. When fear rises, investors move into cash, especially dollars, because they believe it is the safest place to park their money. But this reaction is more emotional than logical. Here's why. The dollar is not backed by physical assets like gold anymore. It is backed by debt, and a lot of it. Governments create money through borrowing, and as long as people trust the system, it works. But when that trust starts to weaken, the value of that currency can fall very quickly. And this is exactly where things start to get interesting. There are growing signs that major global players, especially in Asia, are slowly reducing their dependence on the dollar. Not in a sudden or aggressive way, but step by step very strategically. For example, instead of holding large amounts of U.S. government debt, some institutions are quietly shifting their reserves into other assets. One of those key assets is gold. Why gold? Because gold has no counterparty risk. It doesn't depend on a government promise. It doesn't rely on interest rates. It doesn't default. It simply exists as real value. Now imagine this scenario. If a large country decides to reduce its exposure to U.S. debt, it cannot just sell everything at once. That would crash the market and create political tension. So what do they do instead? They slowly stop buying more. As existing bonds mature, they don't replace them. Over time, their exposure decreases without causing panic. At the same time, they increase their holdings in gold and other real assets. This is a long-term strategy, and it is already in motion. At the same time, a new financial structure is quietly being built. Systems that allow countries to trade directly with each other without using the dollar as a middle currency. This reduces dependence on the dollar and gives more control to those countries. Another important development is happening in the gold market itself. In Western markets, like futures exchanges, prices are often driven by paper contracts, not physical metal. This means prices can be influenced by trading activity that doesn't involve actual gold or silver changing hands. But in Asian markets, especially in physical trading hubs, the focus is shifting toward real metal. This creates a gap. On one side, you have paper markets, where prices can be controlled in the short term. On the other side, you have physical demand, which reflects real supply and demand. And when physical demand becomes stronger than paper supply, the system starts to break. We are already seeing early signs of this. Reports suggest that physical gold availability is tightening in some regions. Demand remains strong while supply struggles to keep up. This is not something that happens in a normal market. It signals stress beneath the surface. Now let's connect this back to the bigger picture. If trust in the dollar weakens, and at the same time physical demand for gold rises, then capital will start moving out of financial assets and into hard assets. This is how major financial shifts happen. Not suddenly, but gradually, until one day it becomes obvious to everyone. And when that moment comes, the price movements in gold and silver can be very fast and very aggressive. Now, let's talk about silver, because what's happening here is even more unusual and potentially far more explosive. Most people focus on gold when they think about safe haven assets, but smart investors are watching silver very closely right now. Why? Because silver is not just a monetary metal like gold. It is also an industrial metal. That means it has two sources of demand at the same time. On one side, investors buy silver for protection, just like gold. On the other side, industries need silver for manufacturing, especially in electronics, solar panels, and new energy technologies. So when demand increases from both sides at once, the pressure builds very quickly. But here's where things get really interesting. There are strong signs that the silver market is under stress. Not in price yet, but in structure. Let's simplify this. In markets like COMEX, silver is mostly traded through paper contracts. These contracts represent silver, but they are not always backed by physical metal ready for delivery. This works fine as long as most traders don't ask for actual silver. But what happens if more and more participants start demanding physical delivery? That's when the system starts to crack. Right now, we are seeing something very unusual. Open interest in silver has dropped to extremely low levels, the lowest in many years. In simple terms, this means fewer traders are willing to stay in the market. But why would that happen? Because confidence is falling. Big players like bullion banks and market makers appear to be reducing their exposure. Instead of taking new positions, they are trying to exit. This is not normal behavior in a healthy market. At the same time, available silver for delivery is shrinking. This is critical. When supply is limited and demand starts increasing, prices should naturally rise. But if prices are not rising accordingly, it suggests that something is holding them down, at least temporarily. This is where the difference between paper markets and physical markets becomes very important. In some regions, especially in Asia, silver prices are higher than in Western markets. Normally, traders would take advantage of this difference through arbitrage, buying cheap in one place and selling high in another. But right now, that process is not working efficiently. Why? Because of added costs like taxes, logistics, and restrictions. These barriers prevent the market from balancing itself properly. And when a market stops functioning smoothly, it creates tension. Think of it like a pressure cooker. The longer the pressure builds, the stronger the eventual release. Another important factor is supply control. There are indications that some countries are becoming more protective of their silver resources. Instead of exporting freely, they are tightening control. This reduces global supply even further. Now combine all these factors. Limited physical supply, falling participation in paper markets, strong industrial demand, growing investor interest. This is not a normal situation. This is the kind of setup that can lead to a major price move, not slowly, but suddenly. And here's the key point most people miss. Silver markets are much smaller than gold markets. That means it takes less money to move the price. So when capital starts flowing into silver in a serious way, the price can rise much faster than gold. That's why many analysts believe silver could outperform gold during the next major cycle. But there's also risk, because before a big move happens, markets often become unstable. We may see sudden drops, volatility, or confusing price action. This is usually the final phase before a breakout. So if you're watching silver, don't just focus on price. Watch the structure of the market. Because right now, the structure is telling us something very important. Something is changing. Now let's step back and look at the bigger picture, the global economy and how all of this ties together. Because it's not just gold and silver markets that are signaling trouble, almost every part of the system is under stress. Take energy, for example. Energy is the foundation of every economy. Without affordable electricity, gas, and oil, manufacturing slows, transportation becomes expensive, and even basic services get disrupted. Right now, Europe is facing serious energy problems. Gas reserves are low, some major fields have been closed, and policies aimed at renewable energy have, ironically, created fragility. High energy prices are already impacting industries from steel to agriculture. Fertilizer costs are up, which will make food prices rise. And this is just the start. When energy prices go up, inflation follows, and inflation eats away at purchasing power. What most people fail to realize is that inflation doesn't hit evenly. It hits hardest on necessities: food, heating, transportation. The effects ripple across the economy. People start paying more just to survive. Businesses face higher operating costs, and governments struggle to keep up. In some countries, this could lead to rationing of electricity and resources. At the same time, credit markets are vulnerable. Stock markets may appear stable, but they are heavily dependent on cheap credit. When interest rates rise, bond yields increase, and suddenly that bubble of easy money can start to burst. Rising yields make borrowing more expensive for everyone, from governments to businesses to individuals. The result? Assets that were inflated by cheap credit, like stocks and property, start losing real value. Now connect this to precious metals. Gold and silver are real money, tangible, finite, and independent of government promises. Unlike paper currencies and bonds, they cannot default. This is why central banks are buying more gold and why smart investors are moving into silver even in these volatile markets. These metals act as insurance against systemic risk. They hold their value when currencies weaken and credit markets fail. There's another layer we need to consider: geopolitical risk. Conflicts in regions like the Middle East can create immediate shocks in energy markets. Even a short-term disruption can send oil prices soaring and trigger a chain reaction across global markets. When energy prices spike, inflation accelerates, and financial stress grows. Investors often underestimate this risk because it doesn't always show up in the news immediately. Meanwhile, global players like China are taking a long-term view. They are building systems to reduce dependence on the US dollar, expanding their own financial centers, and securing access to strategic resources, including gold and silver. This is not a short-term reaction. It's a strategic reshaping of global finance. By controlling supply, holding physical metals, and establishing alternatives to the dollar, these countries are quietly positioning themselves to benefit when the old system falters. So what does this mean for investors? First, it confirms the importance of diversification. Holding real assets like gold and silver isn't just about speculation, it's about protection. Second, it highlights the risk of relying too heavily on credit-dependent assets like bonds or equities. And finally, it shows the importance of timing. The conditions are being set now for major moves in precious metals, energy, and global currency dynamics. Now it's time to pull everything together and talk about what this all means for you, your savings, and your portfolio. The situation we've outlined isn't just theoretical. It has real consequences for anyone holding money, assets, or investments today. First, let's be clear. Credit markets are fragile. Stocks, bonds, and other paper assets depend heavily on trust, cheap borrowing, and stable interest rates. When inflation rises or energy costs spike, that trust starts to crack. Bubbles that seem stable today can collapse suddenly, leaving even strong equities losing value. That's why many experienced investors are shifting focus away from traditional credit and paper investments. Second, liquidity matters. You always want some cash on hand, not as a main investment, but as a way to act when opportunities arise. If markets drop sharply, having liquidity allows you to buy undervalued assets, whether that's metals, real estate, or businesses. But the real core of protection is holding real money, tangible assets that cannot default or be manipulated. That's gold, silver, and even certain industrial metals like copper. Gold is the cornerstone. It's universally recognized, highly liquid, and holds its value across currencies and borders. Silver is especially interesting right now because it has dual demand, both as a store of value and for industrial use. Limited supply, rising physical demand, and structural weaknesses in paper markets make silver potentially explosive in the next phase of market shifts. Here's the final takeaway. Diversify wisely, maintain liquidity, and hold tangible assets. This is not just a defensive strategy. It's a proactive way to position yourself for the next wave of financial change. Central banks know this, which is why they continue to accumulate gold and reduce exposure to unstable credit systems. You can follow their lead without relying on complex financial instruments or speculation. For anyone who wants to stay updated and understand these dynamics as they unfold, make sure you're following Gold Silver Scope. Here, we break down gold, silver, and global financial trends into clear, actionable insights so you can protect your wealth and make smarter investment decisions.